Have you ever looked at a huge company and just wondered, are they actually doing as well as they look? Well, there's a way to find out. And today, we are pulling back the curtain on one of the most powerful tools in finance, the balance sheet. It's a pretty big question, isn't it? I mean, you could spend weeks reading reports. But what if you just need a quick, reliable financial checkup? Turns out, there's a statement designed to do exactly that. Now, the fancy name for it is the Statement of Financial Position. But honestly, the best way to think about it is as a photograph. See, other statements, like an income statement, they're more like a video. They show you how a company performed over a whole year. This is a snapshot. It freezes one single moment in time to give you a crystal clear picture of what a company owns versus what it owes. Okay, so let's dive right in. To really understand this snapshot, you only need to get your head around one simple, powerful, and totally unbreakable rule. It's pretty much the foundation of all accounting. Here it is. Assets equals equity plus liabilities. Now think of it this way. All the stuff a company owns, its assets, had to be paid for somehow, right? The money for it had to come from somewhere. It either came from the owners themselves, which is the equity, or it was borrowed from someone else, like a bank. And that's the liabilities. That's the whole idea right there. This one little formula unlocks the entire balance sheet. So let's break that down. First up, assets. Just think of these as all the valuable things the company has control over. You know, anything from cash in the bank, the company headquarters, the machines on the factory floor, to the boxes of products sitting in the warehouse. Next up, liabilities. This one's pretty straightforward. It's simply what the company owes to other people. We're talking bank loans, bills from suppliers, you name it. If it's a debt, it's a liability. And finally, we've got equity. This is the owner's slice of the pie. It's the money they've personally put into the business. So here's a simple way to think about it. If the company sold off all its assets and used that cash to pay off all its liabilities, whatever is left over, that is the equity. All right, so we know our golden rule starts with assets. But what really is an asset in the eyes of an accountant? Because it turns out not everything a company has can actually make it onto the list. So to be officially listed as an asset, a resource has to pass a little 4-point check. First, does it have the potential to make the company money down the line? Second, is it something the company has an exclusive right to? Third, does the business actually control it, probably because they bought it in the past? And finally, and this one is super important, can you reliably put a price tag on it? If you can say yes to all four, then boom, it gets a spot on the balance sheet. Now, once you have your list of assets, accountants split them into two main buckets, and it all comes down to one thing: time. Specifically, how fast can you turn it into cash? The non-current assets are the big, long-term things, the stuff the company plans to use for more than a year, like their buildings or their delivery vans. Current assets, on the other hand, are the short-term stuff, things you expect to turn back into cash within the next 12 months, like the products you're about to sell. And you can see this in action right here. The life of these current assets is this constant spinning cycle. A company uses its cash to buy inventory. Then it sells that inventory, often on credit, which creates what we call receivables. That's just the money customers owe them. And once those customers pay up, it all becomes cash again, ready to start the cycle all over. So that covers what a company owns. But what about what it owes? Let's flip over to the other side of our equation, which tells the story of where the money for all those assets actually came from in the first place. When it comes down to it, there are really only two sources: the owner's claim, which we call equity, and the lender's claim, which are the liabilities. And just like with assets, liabilities get split up too. You've got your long-term or non-current debts, like a big business loan, and your short-term or current debts, like the bills you got to pay next month. Understanding that mix is a huge clue to how financially stable a company is. Okay, we've got all the building blocks. Now for the fun part. Let's put them all together and see this whole balancing act play out for real, with an example from a company called Bree Manufacturing. All right, let's look at Bree's books. This is the what we own side of the story, the assets. You can see their long-term, non-current stuff at the top, property, equipment, and vans, and then below that, their short-term, current assets, inventory, what their customers owe them, and cash. So, you add all of that up, everything Bree Manufacturing has to its name, and what do you get? A grand total of £147,000. All right, remember that number. Lock it in. Okay, now for the cool part. Where did that 147 grand actually come from? Well, this side of the sheet tells us the whole story. We can see the money the owners put in, that's the equity, plus the long-term loans and the short-term bills they owe. And when you add all of that up, what do you think you get? Yep, 147,000 pounds. It's a perfect match. The two sides are in balance. And look, this isn't just some happy accident. It's like the law of accounting. The value of what you own must always equal the value of the claims against it. That's why they call it a balance sheet. It literally has to balance every single time. Okay, so it all balances out, which is pretty neat, but how do we actually know we can trust these numbers? I mean, what's to stop a company from just, making things up? Well, there is a whole rule book everyone has to follow called accounting conventions. They exist to make sure everything is consistent and fair. For instance, one rule says you have to record an asset at the price you originally paid for it, not what you think it's worth today. Another rule assumes the business is a going concern, that it's going to be around for a while. These shared principles mean you can actually compare the balance sheets of different companies because you know they're all playing the same game by the same rules. And that's it. That's the balance sheet in a nutshell. A perfect frozen-in-time snapshot of a company's financial health on one specific day. But that leaves us with one last pretty big question, doesn't it? A photograph can tell you exactly where a company is right now. But does it really tell you where it's going?